then. I'd like to start by welcoming everybody. I am Ann Spadero. I am the wellness coordinator at South Pointe Hospital, where we are looking at our financial wellness as part of our whole wellness. We are very happy to partner with First Federal Lakewood. And today we have Chalana Williams, who is going to open up and introduce our speakers. Today's topic is considering home ownership. So go ahead.
Thank you. Thank you, Annie. Thank you, Carolyn. As I said before, I enjoy working with both of you. I'd like to personally welcome all of you to our financial wellness workshop. A special thank you to Dr. Margaret McKenzie and Cleveland Clinic South Pointe Hospital for the invitation to collaborate in offering this program. First Federal Lakewood is a community bank, and we welcome opportunities such as this because we place emphasis on empowering our customers and our communities by providing financial education that enables them to make sound financial decisions and to set attainable financial goals. Our hope is that these workshops will assist with financial wellness and in turn contribute to physical well-being, improving the quality of a person's life. Because when you are stressed out over finances, it can really have an impact on your health. So that is the goal of these workshops. Last week, our workshop covered debt management and developing money management skills. Today, this workshop will cover what you need to know when considering home ownership and your personal finances to make sure that you're ready when that opportunity occurs to achieve your goal of home ownership. We'd also like to invite all of you back on March 16th as we conclude the financial wellness series with the topic, Investing Toward Retirement. Please feel free to invite family, friends, and coworkers to attend the last workshops of these series. Joining me today as your facilitators are Lisa Bain and Valerie Morton. So let me tell you a little bit about these dynamic ladies that you're going to spend the next half hour to an hour with. Starting with Lisa, she's an area sales manager who joined First Federal Lakewood in 2017, and she has more than 25 years of experience in mortgage lending and in the financial services industry. She prides herself on being hands-on with customers for the entire mortgage loan process. Valerie Morton joined First Federal Lakewood in 2020, and she has 12 years of experience in the financial services. Valerie loves working closely with her customers to help them choose the best products for their needs and to help guide them along in their journey to home ownership. So with that being said, you are all in good hands. So at this time, I'd like to turn the program over to Lisa Bain.
Thank you, Chalana, and thank you everybody for joining. I think it's very important, the home buying process, that you understand it before you get started, so you know what you're going to need to know. So this is a great program. I've read through it, taught many of courses, and this is definitely one that will help you through the process. So thank you very much. Thank you. Buying a home involves so many major decisions, which can be both exciting and a bit intimidating. But don't worry, this workshop is designed to help you become familiar with the home buying process. You will learn ways to prepare to apply for the loan, understand the terms of the loan, review the one-time and ongoing costs associated with homeownership, and explore methods to build your personal and financial readiness from the home. Let's begin by getting an overview of the topics you'll cover today that will help you prepare for home ownership. We're going to go to, I think, back up one more slide if you would. Perfect. Wonderful. Today we'll cover some important information to help you prepare for home ownership, such as how lenders may evaluate your loan application, steps you can take to better prepare for getting ready for the loan, and costs associated with your home ownership. Let's explore some of these. How to find out if you are financially ready to own a home, the loan and repayment process, and the costs and responsibilities associated with home ownership. You should you should leave today with a greater understanding of how to begin working towards this home ownership. Many people are unclear about the benefits and the challenges associated with owning a home. Let's take a minute to view some of these. So let's go to slide 3, Jelana. People often don't know whether to keep renting or to buy a home. They wonder, how does buying compare to renting? It will save me money. Will it save me money in the long run? There are some pros and cons to owning a home, so let's review some of them. Let's say a home has a long-term value. How many of you think this is a pro or a con? And in some of the classes, we would have you answer, but I'm just going to we don't need to actually answer this. It's just to kind of think about some of the things in evaluating whether homeownership is right for you. You need to make payments towards a home. Is this a good thing, a pro or a con? You need to pay taxes on the home. It's also another thing. You can remodel your home any way you would like. And how many of you think, oh, we're talking about remodeling. All right. As you can tell, there are many risks and rewards to owning a home. Let's learn more about whether that statement we just discussed, the pros and the cons, are for you. Let's go ahead to slide number 4. All right. What are the pros and cons of the idea that a home has long-term value? Owning a home is an investment in a property, which is a type of asset. Many people assume that they can always sell their home for more money than they paid for it. But it's important to remember that there is no sure way to predict a home's future value. The long-term value of your home can depend on factors beyond your control, such as the real estate market in your area. And if anybody's watching what's going on right now, this is one of those times where values are very high. Anyone who invests in real estate should understand the risk that the property value may increase or decrease over time. A home is generally considered to be an asset, meaning its value increases over time. However, it's important to understand that there's no guarantee that you will make a profit whenever you decide to sell your home in the future. It isn't as simple as selling the home for a higher price than you bought it for. You spend money on repairs, maintenance, renovations. You may not be able to earn any that money back, so to speak, by selling your home for a higher price. Not all renovations increase a home's value. So whether or not to invest in real estate by purchasing a home is really a personal decision that you can depend on varying factors of your life. It can help to think of homeownership as investing in a place for yourself and your family and investing in the community, but not necessarily investing in an asset that you can sell for a larger profit in the future. What are the pros and cons of the idea that you need to make a payment towards a home? Well, a portion of every monthly payment goes towards principal, which is the amount you borrow to the lender, and it gets closer to fully owning a valuable asset. But con, you need to make a larger down payment up front, and there may be many other one-time and ongoing home ownership costs. What are the pros and cons of the idea you need to pay taxes on a home? Well, home ownership may be able to deduct mortgage interest and property taxes on your taxes, so that's a benefit. But con is you pay property taxes, which you wouldn't be responsible for as a renter. What are the pros and cons of you can remodel your home any way you like? You can renovate and decorate your home any way you want. I know my son in Columbus can't even hang anything on the wall right now because he's not even allowed to put a nail in the wall. So it's kind of a downfall. He doesn't really get to feel like it's his home. Con, you're responsible for all those wonderful repairs and maintenance costs. Have any of you thought about the homeownership pros and cons before? Have you kind of gone through that? Are there other factors that you've considered pros and cons that weren't mentioned? One could be you could be buying a 2-family property and you could be receiving rent income for one of the units if it's not a single family. What pros weigh in for you most important, and what cons weigh in for you as most important? So do the pros outweigh the cons? Knowing the pros and cons of buying buying helps you have a realistic approach and to know what to expect when you move towards your home ownership. Let's go ahead and look at number 5, common terms. Most people can't afford to purchase a home without getting a mortgage, which is a loan for the purpose of buying the home. A key way to prepare for home buying is to understand what lenders are looking for in a borrower. The key questions to ask yourself: how can I prepare to get the most valuable loan possible? Understanding terms is an important part of preparedness because you will hear these terms often from lenders and others in the home buying process, and will see them on loan applications. Let's begin by exploring some of these common terms and why they're so important in the home buying process. Why are income and income histories important to a lender? Income and income history informs a lender whether a borrower has resources available to repay the loan. Income can be different types of ways. It can be salary, it can be Social Security, it can be investments, it can be a whole bunch of different things. What is debt to income? Debt to income is a percentage that tells the lenders how much of a person's monthly income before taxes, which is called gross, goes towards debt payments. Lenders prepare to loan money to people whose expenses are typically less than 43% of their monthly income. Why are credit scores important to a lender? A credit score reveals to a lender whether a person repays his or her debts on time. A very good credit score can indicate to a lender that you'd be less of a risk to lend money to. You may qualify for more favorable terms as a result, and that is the case in lending, even with interest rates, amount you can borrow, and the different types of loans that are available to you. And why is a down payment important? If you started saving money for a home, you could put that towards a down payment. A down payment is generally a lump sum of cash that you can use to pay for a part of the home purchase. Having enough cash for a down payment shows a lender that you are committed to the purchase and that you will likely repay a loan. Having savings also shows lenders that you have a safety net in case any emergencies or unforeseen circumstances come up. A few reasons why people may default on their loans and become unable to make payments are family changes such as new baby, elder care, which increases expenses, an accident, which may require medical attention, or time off work and result in an increase in expenses or a decrease in income, or a change in job status may cause income to decrease. Lenders prefer candidates who are low risks, meaning those who are well prepared to pay their mortgages even if these present circumstances happen. A major concern for lenders is typically, can you pay back a loan? A borrower has a steady income, savings, a good credit score, a good DTI is typically considered low risk and thus probably more likely to pay his or her mortgage on time. On the other hand, a person without a steady job or income, or with little savings, poor credit, or a high DTI may be more likely to default on a loan and thus may be considered high risk. Being a good candidate for a loan is one of the factors that determines the amount of money and the interest rate you receive. Thus, it is important to be the best candidate. Let's look at one strategy of preparing to be a good candidate. That's going to be slide number 6. In general, lenders use 5 criteria to determine credit worthiness, and those are sometimes called the 5 C's for credit. Knowing them can help you prepare to become a good candidate for a loan. Lenders use the 5 C's to find out a few things about you. Capacity is your ability to pay your bills now and in the future. If you have a steady job or profitable business, lenders will see that you should be able to pay your bills. Capital. Capital is readily available money and savings plus investments, properties, and other assets that you could sell fairly quickly for cash to pay back on a loan. Assets are any items that have significant monetary value. Collateral. is the property or the possessions of value that you can put up as security against your loan. Character is your history of delivering on commitments. If you make your payments on time, you'll be considered a low risk borrower. And conditions are the purpose of the loan and any factor that may affect your ability to prepay. How can you show capacity to pay bills now and in the future? Responsibilities may include employment history, current pay stubs, and earnings from a business. What are some examples of capital that a person could have? This would include cash, savings, investments, and valuables. What type of collateral could a person offer to secure? Cars, motorbikes, lands, other homes, and other valuable items. For a mortgage, the home you borrow money to purchase is the collateral on the loan. How can you demonstrate character to a lender? Establish a history of making on-time payments of debts and bills. How can conditions affect how a lender view your mortgage applications? Responsibilities may include the fact that since specific purpose of a mortgage is to buy a home, this may reflect more positively on you than if you sought a more general loan that could be used for any other purpose. The lender will also consider a variety of factors in your life that could affect your ability to repay. Another step to help prepare for homeownership is to have an accurate picture of your current financial situation. Looking at 2 of the 5 C's, capital and collateral, can help you access your financial situation. How much capital do you have to access, and how much does it affect the home buying process? Excuse me. What is collateral, and how can it help you in the home buying process? Capital refers to cash, savings, and assets you know that have significant value, such as a car, real estate, investments, or jewelry that you could quickly sell for cash. To determine your personal capital, list all these items you own on and their appropriate value. Knowing the value of these items is important because if you can show lenders that you have assets with cash values that could be applied to the loan payments. Collateral is basically an asset that the lender could use as security in exchange for giving the loan. Your new home is collateral for the mortgage. That means if you're unable to afford mortgage payments for a period of time, your lender may take your home. If you have little credit history, lenders may feel more comfortable giving you a loan if you have collateral to secure. Now that you have a basic understanding of some important terms and how your assets may roll, let's discuss how you can access how ready you are to buy a home. All right. We have a participant's guide. I don't know if some people gathered that, but there is a participant's guide that you could use. We're not going to use that today, but it can be used. And Val, when she talks about some of the other things, we'll be able to go ahead and kind of discuss, or you can use that as a guide. I'm going to go to slide 7 if you want to. Is that it? Yep. All right. By using spending and saving actions plans, which you can get through your participant's guide, you'll be better able to understand and evaluate how you spend and save your money. These tools will help you see areas where you can cut costs and where you can save money for things you really want. Since a home purchase involves many upfront costs as well as ongoing costs for maintenance and repairs, it is important to evaluate your current spending and to make room in your budget to build a savings reserve for home expenses. Right? Okay. Right now, let's meet Christina. I think that's part of the participant's guide right here. Christine, okay, yes. Right now, let's meet Christina and look at part of her spending action plan. Christina is a single mother with a 10-year-old. She currently works 2 jobs. She created a spending action plan that includes her current expenses and what she regularly spends her money on. Christina's spending action has 2 sets of expenses, needs and wants. Needs in this section, Christina used the itemization sheet to write down necessities she pays for each month and how much they cost. In this section, Christina wrote down what else she spends money on month to month and how much each one costs. You can track these for yourself as well in the participant guide. How much could Christina have saved this month? So let's look at here. She has rent, credit card payments, auto insurance, other household expenses, no student loans. That's a first. We usually see those everywhere. No court order payments. And then she has groceries transition. So her total expenses is $1,755. I just need to move my little camera here. Then she has her wants, her fast food, movies, cable TV. I don't know. I feel like cable TV is kind of in a need. Just kidding. And data plan for cell phones. That also probably needs to be on the needs. But those total expenses are $360. Having a list of things you spend money on is helpful in two ways. You can track your spending. It can show you areas where you can save. Reducing spending on even small items can add up to a big savings. Identifying exactly where your money goes each month can be powerful exercise. Cutting or lowering some of your expenses can free up money to set aside for a down payment, future mortgage payments, or other home-related expenses. This can help you save for a big goal even faster. You can track what you earn. It can give you a clear picture about the following. What kind of house can you afford? What kind of down payment can you make? And how well prepared are you for extra costs associated with the home ownership? All right. Again, we're not going through the actual participant's guide, but this is a good example of what a financial action plan looks like. So please feel free to use the participant's guide and use this to figure out your action plan. I think at this point, we're going to go to slide 8. And I'm going to hand this over to Val so that you can hear someone other than me talking on this call. So go ahead, Val. Thank you.
All right. Thanks, Lisa. I'm going to apologize now if you guys happen to hear my 2 dogs. They are quiet for the moment, but I just want to say sorry. Okay, so kind of to dig in deeper and to expenses that Lisa was going over. So another of the 5 C's is capacity. And capacity is your present and future ability to meet your payment obligations. One of the ways that lenders calculate your capacity is by determining your debt to income ratio, or as we've often referred to it as DTI. DTI is calculated in this way. You divide your total monthly debt payments by your total monthly income. Then you multiply that number by 100 and you receive a percentage, which we call your debt to income ratio, or DTI. In general, the lower your DTI, the better your balance between your debt and your income, and the more money you'll likely be approved to borrow. So on the slide that we have here, we are introduced to Marta. On the slide, we have some information that will allow for us to take a glimpse at her finances to help us with understanding her DTI by learning how to calculate it. So basically, as we kind of stated earlier, there are 2 steps really in figuring out someone's debt to income ratio. First, you're going to take their expenses and you're going to add those all up. So we see that she has a student loan payment, car payments, and payments that she makes towards her credit cards each month, which equals out to be $1,700. You're okay. The next step is to take that monthly total that we got for the debt payment and divide that by her total monthly income. So we said that her total debts that we calculated was $1,700, and we can see on the screen that her monthly gross income is $4,000. So if you take that number and you divide it, you get a DTI of 0.425, which equals 42.5%. So another way of kind of like looking at that is that her debt makes up 42.5% of her income. When it comes to qualifying for a mortgage from a financial institution, your DTI often must be lower than 43%. It does vary really by the program that you go in, but basically lenders tend to look at borrowers who have a higher DTI of being a higher risk or having a higher potential to possibly have trouble in the future with making payments, which is why they give that suggestion in this presentation that it's encouraged to have your DTI be lower. Along with the slide, as Lisa has mentioned, there is a participant guide. In the participant guide, there is a activity that you can go through that'll help you with calculating your own debt to income ratio. Remember that estimating your DTI is helpful, and it's a helpful step in better understanding how potential lenders might evaluate your loan worthiness. So take some time to kind of go through that. All right, so we've kind of learned that your capacity or your ability to pay bills and repay loans is important to lenders. It also affects your credit score, which is another factor that can have a big impact on the type of loan that you qualify for. So I'm going to have Shalana go to the next slide. Thank you. All right, so your credit score reflects how responsibly you've paid your bills in the past. Your credit score can have one of the biggest effects on your financial life, including the mortgages for which you're able to qualify for. Lenders consider your credit score when determining whether to approve a loan, and it also helps with determining the amount that you would actually qualify for. Your credit score represents your credit report, so basically your history. They're used by companies and financial institutions to assess your risk. A lot of people use credit scores these days, from your insurance, utilities sometimes we'll pull them these days. So it's a big factor, and it's important to kind of like make sure that you take a look at it. There are many types of credit scores, which we just kind of went over, such as the FICO and the Vantage score. They generally range from a score of 300 on the low end to 850 as the highest. Generally, a low number means that a person is considered a higher risk, which we have kind of discussed a little bit here today. And the higher the credit score means that the person is typically considered to be a lower risk to the bank. Credit scores are determined by looking at the information that are recorded by the three major credit bureaus, which are Equifax, Experian, and TransUnion. We talked about a little bit of having a higher score means that you have a lower risk, which also correlates to most times being able to get a lower interest rate with those mortgage companies. It is important also that you review your credit report and score frequently. You have access through the website annualcreditreport.com through the Fair Credit Reporting Act to receive a free copy of your credit report annually. So that's something that I do encourage a lot of people to look at, just to make sure that the things that are reported on there are reporting accurately. And if you should find something that isn't on there or that you may not understand, it's best to reach out to those bureaus to work on getting those types of things straightened out. There are some helpful things that you can do to kind of help with managing your score. One of the key things is, of course, using your available credit wisely. It's recommended that you use less than 30% of your credit availability each month. So that means basically don't max out your cards, essentially. Pay your bills on time, which is a given. You want to make sure that your history is showing, positively as far as your payments that you're making. And overall, by making payments on those loans, you're bringing down the monthly debt totals that you do have. Pay your bills off on time, so don't default on them. It's a constant thing, making your payments on time. Limit your credit applications. Your inquiries are also something that goes into your credit score. So maybe if you're thinking of purchasing a house within the next 6 to 12 months, we may encourage you not to take any new applications because those can bring down your score some. So that's something to consider when you're kind of like planning out your future. Okay, so well, we've learned many ways to assess your financial situation and to help you better understand how you will be evaluated by lenders. Now let's take a look at the costs associated with purchasing a home. All right, so the costs typically are broken down into these three categories that we see here on the screen. So we have down payments, miscellaneous costs, and closing costs. Understanding these costs within the home buying process will help you better be prepared to make necessary payments in a responsible way. So we're going to kind of, over the next couple of slides, go a little bit deeper into what it means to, or what's all encompassed in these three categories. You can go to the next slide, Shalana. Okay, so we're going to kind of talk here about down payments. A down payment is an initial payment toward the purchase of your home, and it's typically between 3 and 20% of the purchase price. Your savings, loan size, and credit score will determine the actual amount. In general, the larger your down payment, the lower your monthly mortgage payments will be. On the screen here, we're again visited by Marta. It looks like she's looking to purchase a house that costs $80,000. The slide provides us with a couple of examples of different down payment options that a person may be able to take part in. So we see in the first one, she's able to qualify for a program where she doesn't have to put a down payment down. Her interest rate is 5%, and it gives us the amount of interest that she's paid in that first year, which is $3,900. In comparison, we have scenario B, where Marta was able to save up a decent amount of money to put down on her home. So she saved $20,000 and put that down, which reduced the loan amount to $60,000, which allowed for her to get a lower interest rate. So we can see that instead of the 5% that she got in scenario A, she was able to qualify for 4.5, which then in turn did save her over the course of that year. Instead of paying $3,900 in interest, she only ended up paying $2,700. So that's something to really think about when it comes to purchasing a home. Your down payment can be a decent contributing factor to some of the other parts that are associated with it. So some of the common questions that people have, is it possible to purchase a home without having a large down payment? And I feel like this scenario does really kind of get into that. Yes, it is possible, but it can be a little bit more expensive when it comes to the interest that's associated with it. While some home buyers qualify to buy a home without a down payment, most people put some money down at purchase. The more money you're able to put down, the lower your monthly payments and interest may be. You may qualify for a low down payment mortgage through government guarantee programs, such as the Federal Housing Administration, the U.S. Department of Agriculture, and the Department of Veteran Affairs. We'll talk a little bit more about those specific types of loan programs here a little bit later. Another common question that people have is kind of what does the down payment indicate to a financial institution? And like we've been saying a lot lately in this particular presentation, that it shows that your level of risk isn't as high. Financial institutions tend to recognize buyers with down payments as a better prepared for the home buying process and less of a risk. Because buyers with down payment are investing some of their own money, they're borrowing less than the full purchase price from the financial institutions. Lenders thus can offer borrowers better terms on their loans by doing this. So kind of referring back to the slide, there's a difference here by this particular borrower being able to put down money. She saved not 12,000, but 1,200 over the course of that first year by just kind of being a little bit better prepared when it comes to the costs associated with the down payment. So now that we've discussed down payments, we'll move on to cover the miscellaneous costs associated with loans. All right, so on the screen here, we have a few different things that kind of go into that section of the cost related to home buying. When you're buying a home, you generally pay all the costs that are associated with that transaction. However, depending on the contract or the state, the seller may end up paying for some of those costs. So we'll kind of go into depth here on the different types here. First, we have the credit check. As you know, lenders do check your credit score, and there is a fee that is associated with that. Buyers usually are responsible for paying that fee. It can range anywhere from $25 to $100, depending on the vendor that particular lender is using. Earnest money is another portion of the miscellaneous fees. Earnest money is an upfront cost that later gets applied to other fees associated with the loans. It's basically a way to tell the seller that you are really interested in purchasing that home, kind of like putting your money where your mouth is, as they would say. But how that breaks down or the percentages or on what you would put down for earnest money does depend on like the loan amount and that and your state's laws and whatnot. Another cost that is associated with miscellaneous costs would be inspection costs. Hiring an independent inspector to assess the home's issues or maintenance needs is highly recommended during the home buying process. Buyers are responsible for this cost of the inspector, but the seller may agree to repair any identified problems or, as an alternative, may reduce the purchase price to compensate. The inspector provides a detailed report of all aspects of the house, including the quality of the roof, plumbing, appliances, gutters, and so on. Inspection costs can depend on the size of the house, but it is something that we do really recommend that borrowers do get done before their home buying process is completed. Another miscellaneous cost is repair costs. Necessary and or required repairs are often noted in the inspector's report that we just kind of talked about with the inspection costs. Usually the seller will agree to fix any problems that are associated with it, but sometimes depending on the conversations that are had, the buyer does end up being responsible for it. So that's just something important to kind of take into consideration when looking at the different miscellaneous costs. Then, of course, there are appraisal costs. Appraisals are often required by lenders to ensure that the value of the home is indeed what the seller claims it to be. The buyer may be able to negotiate these fees depending on what conversations that they have with the seller. Again, this is an important thing for the bank to make sure that the collateral that they're taking is going to hold up. But in the current market that we've been in, we've seen some elevated appraisals. So some extra costs may be associated with your home buying process, depending on what your appraisal comes back at as well. Another miscellaneous costs that can or should be considered are ongoing costs, which basically kind of goes over like the maintenance that are associated with upkeeping your house. Typically, maintaining your home can cost between 1% and 4% of the home's value each year. This can include expenses like hiring a pool and yard maintenance services, or making repairs as needed, or updating appliances, remodeling, and things of that nature. So as you can see, there are a good number of things that go into miscellaneous cost. We will now look into closing costs, which is the third section that we kind of described earlier. You can, thank you. All right, closing costs are expenses over and beyond the purchase price of the home. They are paid at the end of the home buying process. When the deal is closing and when, in many states, the title of the house gets transferred from the seller to the buyer. Closing costs may include, but are not limited to, the following: appraisal fees, tax service provider fees, title insurance, government taxes, prepaid expenses such as property taxes, homeowners insurance, and interest until your first payment is due. However, you may be able to negotiate or bargain so that the seller pays some of these costs. The total amount of closing costs may be between 2% and 5% of the purchase price, but it can depend on where the property is being sold and the value of the property. Check your state's laws to learn more about the fees and charges you may be responsible for as a buyer. Now that we know more about the home buying process, let's look at insurance costs that you may need to account for. You can go to the next slide. Okay, so we're going to talk here about PMI, or private mortgage insurance. If you don't make a down payment that's at least 20% of your home's price, you may need to purchase private mortgage insurance, or PMI as we call it. This requirement varies by lender, but let's cover the basics about this a little bit quickly here. Private mortgage insurance is an insurance that guarantees that the lender will be paid the amount of the remaining mortgage if a buyer defaults. So PMI is really something that is put into place to protect the lender if you were to stop making your payments. Buyers who make down payments equal to at least 20% of the purchase price can avoid having to pay PMI. Now, at this point, some people may ask, why would a lender require mortgage insurance? Again, like we've talked before, it has a lot to do with the risk. Mortgage insurance lowers the buyer's risk to the lender, enabling buyers to qualify for a loan for which they may not have otherwise been able to qualify for. Keep in mind that the cost of this type of insurance will be added to your monthly mortgage payment. It costs about $30 to $70 per month for each $100 you borrow. Once you do save, or once your home value is reduced down to 80% of what's your initial, it's reduced by 20%, and you have equity in your home, there is a potential that you can remove your this particular type of insurance. And you just would need to get with your lender to clarify on what the stipulations are to get this removed. The mortgage insurance discussed thus far is associated with conventional loans that you may receive from a bank or a credit union, but there are other types of loans available. So let's talk about the different types of loans that are available to borrowers. We'll have next slide. Okay. All right. Most of the time when we think about a mortgage, we think about a conventional loan that we can get from a financial institution such as a bank or a credit union, but there are non-conventional loans too. Let's find out what they are and the differences between the conventional and non-conventional loans. So conventional loans are loans provided to people who meet certain criteria, including income level, DTI percentage, and credit score. These loans are typically provided by the following organizations: banks, credit unions, and mortgage companies. Non-conventional loans are government loans that are available to borrowers who may not have good credit or have large enough down payment. These loans are provided by the following organizations: the Federal Housing Administration, FHA. The FHA can help insure your loan, can help insure your loan so that you're able to get a better deal through a private lender, such as a bank or a mortgage company. The Veterans Administration, or VA, is for eligible veterans, service members, and surviving spouses. The VA can guarantee a portion of the loan from a private lender. USDA, or the USDA Rural Development Services, for those who are looking to buy a home in a rural area. The USDA offers several types of loan assistance for direct loans and guaranteed loan programs. USDA assistance programs typically are targeted to low and moderate income individuals. Okay. So now that you know more about the different types of loans and what common home buying expenses to budget for, let's address the question that most of you probably have had since the very beginning of this workshop: how much house can I afford? Let's talk about estimating how you can afford let's talk about how estimating, we're going to discuss how we can estimate how much home you can afford. Although lenders ultimately will determine the size of the loan for which you qualify for, you can still get an idea of your affordability range. This number can help inform you on your home search. One estimate is that borrowers typically can afford a mortgage that equals 2 to 3 times their annual household income. The amount of money you're able to provide as a down payment plus the amount of your mortgage payment can give you a sense of the total cost of a home that you can afford. There is an activity in the participant guide that Lisa kind of talked about earlier, where you can kind of go through to help with figuring out an estimation for yourself, on the amount of a house that you could afford. But as always, you can always reach out to your local branches or credit unions and banks to kind of get a more personalized version from them in regards to what that particular bank's criteria is and what they think that you can afford. All right, we can go to the next slide. Okay, so it's important to remember that the estimates that we kind of talked about are just rules of thumbs that are going to be in that participant log. As I said, it is important to kind of like reach out to a financial expert to determine your best home buying budget. So with the knowledge that we've gained so far today, you should be better able to assess whether a home buying is the right choice for you. As you evaluate your personal and financial readiness for home ownership, know that you are not alone. There are resources available to help you plan and understand the home buying process. On the slide here, as well as in the participant guide that you guys may have, is a list of these free resources where you can go and you can get help or information in regards to the home buying process. In addition to your financial institution, there are laws and organizations that protect consumers when buying a home. Use government resources such as the Consumer Financial Protection Bureau and the U.S. Department of Housing and Urban Development to access tools and information on the latest policies. These resources offer step-by-step procedures for all aspects of the home buying process, from shopping for a home to closing a deal. There are many resources available to help you fully understand all aspects of home ownership. If you feel confused or uncertain, you can contact one of the government agencies listed below to walk through the process, or you can always contact your local branch as well to kind of go through what the home buying process is going to be like. All right, and we'll go to our next page here. So you've learned that while some factors like home prices are beyond your control, other factors are within your control to help you prepare for home ownership. As you can see, many aspects of buying a home are interconnected. Generally, the better your credit score, the better the interest rate you may secure. The larger the down payment you make, the less costs you may incur. Home ownership will be within your reach if you do the necessary prep work needed to save for upfront costs to qualify for your loan. Use each section in this workshop to help guide you through the process. Deciding to buy a home is a big step, but it doesn't have to be intimidating. Knowing the right questions to ask and steps to take to get started will help you make the decision. Will help you make the best decision for you. And with that, that's kind of the end. So we'll kind of open it up to see if anyone has any questions.
Val, how do I get a hold of you if I want to get pre-approved?
Yes, I didn't have my, I'm going to put my information in the chat here. And if anyone wants to go over and get a little bit more in-depth example of what we can provide for you here at First Federal, I'll be more than happy to assist with that. Let me put my phone number.
And while she's doing that, please no one leave yet. We want to thank you so much for attending our workshop today. We hope that you walk away with some added knowledge, and we look forward to having more workshops in conjunction with financial wellness and in partnership with Cleveland Clinic South Pointe Hospital in the near future. As I mentioned earlier, we do have our final workshop of this series on March 16th. You're all welcome to attend, and it's investing in retirement. We will have an investment advisor from First Federal Lakewood give that part on the program. And then also we have a treat for you as well. We do have a giveaway of a $25 gift card for all that have registered and attended today. You are in a drawing, and I am going to reach into the bag and see who will be the winner of a $25 gift card. Let's see here. Giovanna Green. Is that, do I see that, Giovanna Green there?
G Green, yep.
Yeah.
Congratulations.
Yay.
Congratulations. So you just won a $25 gift card from
Great.
First Federal Lakewood. We will have it available through Carolyn Sanford or Annie Spadaro, who's still with us from Cleveland Clinic, and we'll make arrangements to get that to you through that resource, okay?
Sure, great.
All right, so please stick around for just a moment. And Val, you said you put your information in the chat?
Yes.
Okay, that's wonderful. One last thing I want to share, Val did mention additional resources that are available. First Federal Lakewood also has additional resources on their website at ffl.net. There you'll find a resource called FFL University. And there are financial literacy modules that a person can take at their leisure online. It covers a gamut of information from home ownership to paying taxes to even financing higher education. So please check that out at ffl.net. It's under FFL University at no cost to you. So again, thank you so much for coming. And if anyone has any questions or comments at this time, please feel free to do so.
I had a question. I don't
Thank
know.
you.
We could, someone had a question, I believe.
Yes, it's Giovanna. Can you hear me?
Yeah, you're going in and out just a little bit, but we'll try to.
know it's probably gonna do that, but that's fine. Hear me if not, I can, question someone asked, better more on a house or make extra payments?
Oh, it's so hard to hear
Yeah.
you.
Can you put it in the chat because we can't hear you? I'm sorry. And we can wait for a moment while you do that. I think I hear her typing. There we go. Is it better to put a bigger down payment on a home or use, it disappeared. Is it better to put a bigger down payment on a home or use extra money to make extra payments? Also, what is the advantage of the VA loan versus other loans? Would one of you ladies like to answer that?
Yeah, I can help a little bit there and then refer over to Val. I think earlier on in the call, we talked about down payment, bigger down payments and or not. So that's where the participant guide's going to help you. What you don't want to do is put a larger down payment and leave yourself with no reserves or cushion, as we would call it. So again, depending on how much assets or liquid assets you have for the house, I would definitely work with your loan originator and use a portion of that saved money as your down payment, but definitely hold on to another portion of it for future reserves, anything that could come up. I'll also make note on the VA loan. You know, the benefit of a VA loan is a no down payment program. Again, you can still put money down on a VA loan. It's going to lower your payment. So depending on where you want to be payment wise, also depends on which program you would want to do.
And then I just want to assure Shantae that yes, it is being recorded, and also in the participants guide, hopefully you did receive that as well. There's information there. So you'll have both the recording and the participants guide for any information that you may have missed. We'll make sure we get that to you.
Awesome.
Any additional questions? We're getting thank yous. Okay. Oh, and Shantae, if you could put your information, just, I'm not sure if you registered or just, but if you could put your information in the chat, we'll make sure we get that to you, like your email address. All right. Before we close it out, any more additional questions or comments? All right. Well, thank you all again and have a good evening.
Thank you.
Thank you very much.
Thank you.